Hello, welcome to Benefits 101. This is an introduction to the UW-Madison's insurance and other benefits plans for 2026. This presentation is for employees who are newly eligible for the Wisconsin Retirement System, also called WRS. During today's presentation, we will talk about the Wisconsin Retirement System itself and our other optional retirement plans. We'll talk about the supplemental insurance plans, such as dental and vision and life insurance. And we'll finish up with the health insurance detail. By the end of this session, you will know how to identify your enrollment deadline. You'll better understand your 2026 insurance plan options and where to go for more information. And you'll know how to send in your benefits decisions for insurance as a new hire. There are many helpful resources to learn more about benefits. Please request a copy of these slides for your own use so you can access these websites. For your future benefits questions, you are welcome to contact the Benefit Services Unit that is part of the Office of Human Resources here at UW-Madison. You will also want to better know who your local HR contacts will be. If you're uncertain who they may be, go to our website into the contact section and review the list of HR contacts and find your division, school, or college. There are multiple offices that could assist you with your benefits here at UW-Madison. Your local HR, the Office of Human Resources Benefits Unit, and indeed there are resources out on the Universities of Wisconsin primary website. And sometimes HR will reach out to you with an important announcement. These will be available from your home page on Workday. Workday is an interface that you may use for your job, or it may be where you simply go to review your pay slips and those HR announcements. You'll also find your leave balances here. You'll be able to review the benefits you've elected and are active, and there will be other important items about your employment listed on Workday. For information about paid leave available for WRS eligible employees, there are policies available for your review, and you may speak with your local HR office whenever you want to use your earned leave or if you have questions about using earned leave. An important resource we'll review again and again today is from Employee Trust Funds, whom we also call ETF. They publish a health benefits decision guide each year in which they compare and contrast this year's state-sponsored insurance options. You'll find this resource very useful. As a new hire, you have 30 days from your start date to apply for or waive most state and UW insurance benefits. Pulling up your offer letter, you can also pull up a calendar and then literally count out 30 days from your benefits eligible start date. And that 30th day is the date by which we must receive your benefits choices in order to honor them as your new hire choices. In the future, when you're no longer within your 30-day new employee window, there may still be qualifying life events that allow you to make changes to your initial elections. Not every life event allows the same changes, and each event may affect different insurance plans in a different way. Please see our benefits website and speak to your local HR for more detail. There are many plans available for new employees. There's a list of them here on the screen. And before you enroll in or waive any of them, think carefully about what you need now and for the rest of this calendar year, and also what you might need in the future, because some of these plans will be offered to you now as a new employee, but may never be offering an open enrollment to you again. Now, from that larger list, we've identified some of the plans that do allow enrollment or changes at any time of year. So the accidental death and dismemberment policy, the pre-tax parking program, and the optional supplemental retirement plans may be started or paused and restarted during the year whenever you would like. The majority of our plans, kind of the main insurance plans that employees ask about, though, have only certain enrollments or change opportunities during a year. Right now, during your initial 30-day window is an opportunity to enroll into them. And then in the future, if you have a life event and you apply to make a change within 30 days of that event, or if during the annual enrollment period in the fall you make changes, then those changes can be granted. Following a life event, the changes may be occurring near the life event itself. For changes made during the annual enrollment period, they take effect as of January 1st of the next calendar year. And then here are two types of plans that may not have another enrollment option for you during your career. One is the disability insurance, also called income continuation insurance, or ICI for short. And the others are life insurance policies, with the state group life insurance offered by the state of Wisconsin and the individual and family life insurance offered by the universities of Wisconsin. We'll talk more about these details when we get to that section of our supplemental insurance. If you're enrolling in insurance, when it will begin for you depends on a few things. It depends, for example, on whether we received your applications timely. It also depends on your start date of your WRS employment and the type of employment you hold. Will also be different depending upon which insurance we're talking about at that moment. So we'll review the insurance start dates later as we go through and review each of these plans. Next up, we are talking about enrolling in your benefits, how you might submit your elections or opt-outs, waivers, how you confirm that everything went through smoothly, and then how you begin to pay for the insurance that you do elect. Your first step for benefits enrollments will be to set up your benefits account. This is a different interface than your Workday interface. So for this, you will set up and access a My Insurance Benefits account as a brand new hire. You can do this as soon as your second day of employment. How to set up your benefits account is listed here. You'll first create your My Wisconsin ID, then you'll log into the My Insurance Benefits portal. You'll select the plans and coverage that you want. You'll check any to-do items that remain outstanding on the system. And then finally, you'll review your benefits summary. You'll be doing this even if you plan to opt out or waive all of the insurance plans. So step one is to create your My Wisconsin ID. The first time you want to access your My Insurance benefits, you have to have already created this login. So have these things ready when you're starting the process. You'll want likely your smartphone because there's a free security app that you'll download to prove to the system that it really is you each time you log in. You want to be sure you have your full legal name and a personal email address. Ideally, do not use your @wisc.edu email address. Use something else. And then you'll want your other personal information, social security information, date of birth, address, etc. And then be ready to create a password that will be a combination of letters and numbers or symbols. For your first time access to this My Wisconsin ID setup, you may go to the ETF website listed on this screen, etf.wi.gov/my-benefits. And if you scroll down the page, there is a section about this first time access. You may find the video or the review on My Benefits Help to be useful. Again, more resources about setting up this My Wisconsin ID. It's such an important step. If you haven't yet set it up, you'll need to complete this one-time registration, and there is a knowledge base document, which we also call KBs here on campus, with more information. So when you get to the My Wisconsin website, you'll see a section either to sign in, but you can't do that yet if you don't already have your ID. So you'll look towards the bottom of that sign in section, and it will say, don't have an account? Sign up, and you'll click that hyperlink to begin. As you're submitting your initial setup, if you see a message, something like this, where it says something like, we are unable to verify your identity, or to complete the verification process, you must, then be sure to follow the instructions that are listed on the website. For example, you may want to send them your name, your address, your employer as UW-Madison, and a statement that notes, please verify my benefits account. And then it can take them a few hours for the verification to be complete. Just be sure to follow up with them if you have questions. And now, once you do have your set up Wisconsin ID, you can log into your My Insurance benefits. There is a tile in My UW that will link directly to that system. That may be convenient. There's also a direct website link if you want to save it in your favorites. There's also a link located in the Payroll and Benefits Hub in Workday under the suggested links. So you can reach this by any of these means. And once you're in My Benefits, you can expect to see a few things. There might be a pop-up noting how many days you have left for your enrollment, asking you to review personal information, maybe even noting some to-dos. If you click out of any pop-up, again, you'll see kind of the main page that will welcome you, and it will note again how many days you have left to elect your benefits. It'll note to-do items. It will even note any active benefits if you've already set some up. If you're beginning your enrollment, you can click on the Begin Enrollment button and then begin to walk through the different options available to you. As you're making your submissions, be sure to come back and check your to-do items. Examples of to-do items might be a dependent verification, where they're asking you to download a birth or a marriage certificate or adoption paperwork or the like. And if you are enrolling in any family plans, you do have to provide the following items: the full legal name of your family members, their sex, the relationship you have, whether it's your spouse or your child, etc., their dates of birth, and social security numbers. And then you'll need to follow up with this family enrollment with the official certificates of your relationships, whether it's a marriage certificate or a birth or adoption certificates. We do not need birth certificates for you, the employee. It's just for the family if you are choosing to cover them on your insurance. And after you complete your elections, you'll mark confirm or confirm changes if you've gone back in to make additional elections or changes. And then you can begin to view your active benefits. You may also print your benefits to open up an employee benefits summary report. This is a report that you could print or send as a PDF via email to yourself or to others who need proof of your current coverage. Now, if you cannot submit your choices online, talk to your local HR or payroll contact for assistance. Make sure to do this before your deadline is near, or reach out to my office, our benefit services office at benefits@ohr.wisc.edu if your local office can't assist you. Once your benefits are elected and active, you can begin to review them in Workday. To find your benefit elections in Workday, you'll be in Workday already. You'll go to the Personal section and to the Benefits and Pay section, and then there will be one of the drop-downs that is called Benefits Elections. And from there, you'll see an overview of the benefits that are up and active for you. One of the reasons you'll go into Workday to view your benefits is to ensure that the deductions that are coming out of your paychecks are coming and appropriate for you. The paychecks from the UW are issued biweekly every other Thursday, and talk to your local HR, payroll, or benefits coordinator if you have any questions about your paychecks themselves. What you can expect to see being deducted from your paychecks are the insurance premiums for any of the benefits that you've elected. If you are a 12-month calendar year employee, what you'll see for your monthly insurance premium deductions will be a monthly premium that is split between your first and your second paycheck every month, and they together will equal the full monthly premium that is paying for that very month's coverage. If instead you're a 9-month academic year employee, your monthly insurance premiums will be split between your first and your second check, September through May, to pay for each month's coverage. And you'll see additional deductions being withheld from those same checks to prepay for your upcoming June and July and August premiums. Because if you have an ongoing 9-month academic year appointment, we would expect you to continue to have the benefits over the summer, and then kind of things resume again once fall begins, September paychecks are available, and everything begins again for the year. Here we begin with some actual plan descriptions. We're starting with the retirement plans. There are 2 types of retirement plans at the UW. The first is the Wisconsin Retirement System, or WRS, and it is a mandatory program for those who are eligible for it. And then there are the optional retirement plans, which you may or may not decide to be part of during your career at the UW. So starting with the Wisconsin Retirement System, this is a pension or retirement program that all of us who are state employees and meet certain requirements must participate in per Wisconsin statutes. So what you'll see is that from your paychecks, automatically a percentage of your pay will be deducted pre-tax and sent to be invested in the Wisconsin Retirement System on your behalf. There will also be an employer match going into the system on your behalf, and the employers also pay fees. So when you begin to review these deductions on your pay stubs, in the employer section, you'll see the employer contribution is higher than your own, and that's because they not only match the contribution, they are also paying fees to maintain the program. This year for 2026, the contribution is 7.2% of your WRS income. And then for the Wisconsin retirement system, your contributions are going in, your coworkers' contributions, if they're part of the WRS, are going in, my contributions are going into the system, and everyone's contributions together work to support the annuity payments for each participant's lifetime pension payment. There are two primary contacts for the Wisconsin retirement system. The first is the Wisconsin Department of Employee Trust Funds, or ETF. They have a member services line, they have a very useful website, and they are the ones who actually administer the Wisconsin retirement system. On the other side of the slide here is SWIB, the State of Wisconsin Investment Board. They have their own member services line and their own website, and they are the ones who actually manage the money and invest it into various investment options. So SWIB is the one who is charged with making money for this program. So while SWIB is choosing the investments for us, you can decide which funds, primary major funds, you want your money invested into. By default, all of your contribution and the employer match will go into what is called the core trust fund. So that's the automatic enrollment. It is highly diversified, and it has a 5-year smoothing mechanism when it comes to sharing money with the participants each year. I'll come to that very shortly on the next slide. The other optional fund is called the variable fund. If you choose to be part of this fund, then your contributions and the employer matches are split evenly, 50-50, between the core trust fund and this other variable fund. The variable fund investments, still managed by SWIB, are primarily stocks, mostly domestic stocks, and they may have sharp increases or decreases year by year to the investment performance. Let's go to the next slide and talk about that. On this slide, what you see is a recent history of the Wisconsin retirement system returns, rates, and adjustments. The first column under the core trust fund is the SWIB investment return. This is how well or not the investments actually performed for that particular year. So following 2025, the investment return was a positive 14.4%. The next column, the effective rate, is what is applied to the active employees' accounts who were active all of that calendar year. So employees who were participating all of 2025 saw a gain of 7.5% in their own personal accounts. That's for the core trust fund. If you look instead at the variable trust fund, again, you see the SWIB investment return from 2025 was a fantastic 22.03. And then the effective rate that was actually shared into active employee accounts who were part of the variable trust fund all that year was a gain of 23%. It was rounded slightly. So back to the core trust fund, the effective rate that they share with active employees is created by looking at a 5-year view. They look not only at that most recent year, the 14.4%, but also the 4 years immediately before it. And in a way, it's like an average of that 5-year period. It's not actually a straight average. They have other items that they look at, but you might think of it that way. It's a combination of that 5-year period that then allows them to offer the effective rate for participants from that year. The variable trust fund is a bit different because each line, each year itself helps to create the effective rate for that very year. So the investment return you saw from 2025 was rounded up slightly to be 23%. If you look down in the history, for example, at 2022, that had been a negative return on our investments that year. The core trust fund, though, was still able to provide a positive gain to participants' accounts because of the 5-year smoothing, while the variable trust fund, its loss of 17.82% had been rounded to be a larger 18% loss for that part of participants' accounts. So employees who were part of both accounts in 2022 saw part of their money gain 6.5% and the other part of their money lose 18%. And again, if you were only in the core trust fund that year, you would have only seen the 6.5% gain. And so you have the option of deciding to be part of the core and only the core, which is where your automatic enrollment will be, or you might decide to be part of both the core and the variable. If you do want to opt into the variable, you must complete the election to participate form and send it to employee trust funds. If you are participating in the account, you may participate in it for as long as you'd like, year by year, perhaps for the rest of your life. But if at some point you no longer want to be part of the variable fund, there is a cancellation form that you would complete and send to employee trust funds. You would still be in the variable for at least the rest of that calendar year, but then you could be removed from it the next year after. And again, this is information that you can review and decide upon when you have a chance as you settle in as a new employee. If you find you're pleased with how SWIB is investing your money, you may make additional contributions into the Wisconsin retirement system. These additional contributions can be sent to ETF via direct bank transfer, or you could write and mail to them a personal check, or you can set up a regular payroll deduction to come out of your UW pay. If you choose to make these contributions, you should know that they are only ever after-tax contributions, and there is not an employer match to them. Everyone who is part of the Wisconsin retirement system is encouraged to complete and submit to ETF a beneficiary designation form. It's important because if you were to die before you retired, the account money, the money in the account should belong to someone whom you'd like it to belong to. And there are two different versions of the form. You can look at both, decide which one you prefer, and then fill it out, send it over to ETF. If you ever change your mind about who you wanted to designate as your beneficiary, you simply fill out a new form and send them the newer version, and then they will honor the most recently received completed form. Next up here, we have information about those optional retirement plans. So there are two programs. One is the UW's 403B, which is also called the Supplemental Retirement Plan, or SRP for short. And then we have the state of Wisconsin's 457B, which is also called Wisconsin Deferred Compensation, or WDC, sometimes just called Deferred Comp. There is a side-by-side comparison chart here. The amounts you can contribute are based in part on your age, and they change, or they may change from one year to the next. There is no minimum contribution that you must make to be part of these programs. Neither is there an employer match, and it's up to you to decide whether you want to contribute pre-tax or post-tax. There will be certain admin fees charged based on the record keeper and program that you choose. And you would work directly with those programs if you had questions about the money that is being contributed and how it's being invested. To enroll in one or both of these optional retirement plans, um, we note the steps here on the slide. So first, to enroll in the UW's 403B, you'll decide on either Fidelity or TIAA as your record keeper, as your provider. You may even elect both if you would like to participate with both providers. You'll set up an account on your chosen provider's website, and then you'll submit a salary reduction agreement through Workday to tell us, the UW, that you've elected your program and that this is a certain amount of money that you want to start sending to them every paycheck. On the other hand, if you're enrolling in the state's 457B, they handle everything more directly on their website. So you'll want to find the current plan enrollment code, which they do change quarterly, and then you'll go on to the Wisconsin Deferred Compensation website or give them a call. Let them know that your employer is the UW system, and then follow their directions to set up your account and to designate how much you want to contribute per paycheck. Once you're participating in one of these optional retirement plans, you're welcome to make changes to the amounts you contribute by starting, stopping, increasing, decreasing, restarting when you'd like. To make changes to the 403B, you'll make those yourself in Workday, or to change your 457B, you'll log in to the Wisconsin Deferred Comp website and then use their resources to make your changes directly there. You may have other questions, such as you have a former retirement plan from another employer and you're wondering what to do with that money. While the Wisconsin retirement system won't accept roll-in funds, if you open either the UW's 403B with Fidelity or TIAA or the state's 457B, they will accept roll-ins. So if you open those accounts You would work with your old plan and then now this new plan to coordinate the movement of the money. And that was the short version of information about the retirement programs here available at the UW-Madison. To learn more, I encourage you to register for one of our upcoming retirement planning sessions. We have one called Starting to Save, which is ideal for those who have decades until retirement. There's also a mid-career retirement check-in, which is for those who are nearer to retirement and just want to ensure that they're using the resources in a smart way, reevaluating what they've elected. And then there's the Ready to Retire session for those who might be within 5 years of retirement and want to know more about the retirement process itself. You register for one of these sessions on our website, and though they are recommended for certain parts of your career, you're welcome to attend any and all of them whenever you would like. So we look forward to seeing you there. This next session, we're talking about the supplemental retirement plans, which include dental, vision, life insurance. We'll talk about the disability, the flexible spending accounts, and we'll kind of wrap everything up with health insurance. Today's presentation is, of course, only a review, an introduction to resources. For more information in writing, visit our website and choose the different benefits that you'd like to know more about. Sometimes people have questions about who can be covered on your insurance plans. And so we have a little graph here. You'll note that, of course, you as the employee are welcome to enroll in any and all of the programs. If you have a legal spouse, they are also welcome to be part of most of the programs other than the disability insurance. That's just for you as our employee. We do have domestic partner coverage for two plans that are sponsored by the UW, the AD&D policy and the individual and family life insurance. And then your children are welcome to participate in most of the plans along with you, again, other than that disability insurance, which is just for you. That final column just notes that we don't have any plans that offer coverage for parents. All right, we'll start with the dental insurance. I've taken these screenshots from that Employee Trust Fund's decision guide that I introduced earlier today, and you may want to look it up as you follow along. So the first column here for the Delta dental insurance is called Uniform Dental. This is a preventive dental plan that can be attached to your health election. So if you are enrolling in the state's health insurance, you could also enroll in the Uniform Dental and pay another $4 a month or another $11 a month to have preventive dental for yourself or for your family members. If, however, you are going to waive or opt out of the health insurance plan and you still want preventive dental coverage, then there is the program called Preventive Dental Plan, and you can elect that, again, either for coverage for yourself or to extend to your eligible family members. And then there are the options for major dental. There are two, and you would choose one of them if you wanted some major dental coverage for crowns and bridges and the like. There is the Select plan, which is less expensive than the Select Plus plan, but the Select plan will offer less coverage than if you were electing and paying the higher price for the Select Plus plan. On the next slide, we can compare them. So here is a grid, again, from that benefits decision guide that ETF offers. We have a column that describes the coverage offered in those preventive plans, whether it's the uniform dental that you're enrolling in because you're also enrolling in health, or the preventive plan that you're electing because you're waiving or opting out of health, but you still want preventive dental. And then there are the Select and the Select Plus plans, where you could choose one or the other if you want major dental coverage. Now note that there's important information about who the network providers may be, depending upon which of these options you select. There is an annual deductible that you may need to meet before that program will cover your major dental services. And then there's an annual maximum that each will not pay more than per mouth per year. That's the maximum that this plan will contribute towards a covered mouth. Again, you'll note some information about kind of routine evaluations and cleanings, which are under the uniform dental and preventive plans, but not under the Select or Select Plus. There's also information about the major services like crowns and implants and oral surgery. Those are not covered by the preventive plans, but are instead covered at a percentage by the Select or the Select Plus plans when you're visiting their network providers. And then some of these plans include orthodontic coverage. For the preventive uniform dental plans, they cover 50% of an ortho bill for your dependent children, up to $1,500 for that child's lifetime. The Select plan has no orthodontia coverage, and the Select Plus plan does offer, again, a 50% coverage for orthodontia up to $1,500 for that person's lifetime. But this particular coverage is not limited by age. This particular coverage could allow coverage for adult orthodontia if you yourself or your covered older child or spouse may want to participate with some orthodontia. The dental insurance program works only when you visit their in-network providers. So do visit the deltadentalwisconsin.com website and search for providers based on your area and the type of coverage that you've elected. Now, here are some effective dates when your coverage will begin. If you are enrolling in the uniform dental, because you're also enrolling in the state health insurance and you want the preventive dental, then this uniform dental insurance will begin when your health insurance begins. And you'll see when we get to the health section that there can be different effective dates for health insurance depending upon your personal employee setup. For the other dental insurance options, whether it's the standalone preventive dental or the Select or Select Plus major dental plans, they become effective the first day of the month following your date of hire. Or if your date of hire was on the first of a month, the coverage would be retroactive back to the first of the month. And again, this is all assuming that you have submitted and we've received your choices by your 30th day. Next up, we have vision insurance. The state's vision insurance is offered through a company called MetLife, and what you will pay if you're participating in the vision insurance depends on who in your family you're covering, whether it's coverage just for yourself as an individual, or whether you're also extending the coverage to your legal spouse, or to your eligible dependent children, or to the full family, spouse and children, as well as yourself. And here's an overview of what the MetLife Vision offers. They offer a well-eye vision exam every year for a $15 copay. They'll also have certain allowances for frames and standard corrective lenses if you're getting glasses. There is some coverage for certain lens enhancements. And if you want contact lenses instead of eyeglasses, there is an arrangement for a certain allowance of the fitting itself and then the purchase of lenses. They can be up to a $150 allowance for those purchases each year. Also, as part of the MetLife Vision Insurance comes some additional coverage. There's some diabetic eye care enhancement, there's some LASIK service discounts, and there's even some hearing exam resources that are available to you. When you're using your vision insurance, it's important to visit only in-network providers, and you can find them by going to the MetLife website and looking up your state of Wisconsin Superior Vision Network. The vision insurance is effective the first of the month following your date of eligible hire, or if your date of hire was indeed the first of the month, then your coverage would be retroactive back to that first day of your employment. Again, that's assuming that you've enrolled and we've received your elections within that 30-day window. This section is about the pre-tax spending accounts available to employees. There are 3 flexible spending accounts, or FSAs, offered to employees in 2026. The first is the Healthcare FSA, which allows you to run through certain medical, dental, vision expenses, certain medical prescriptions, and qualified over-the-counter items. There's also a Limited Purpose FSA, which is for only those of our employees who are enrolled in the high deductible health plan with its health savings account, and it can be used to run dental and vision expenses or post-deductible medical expenses. And then there's the dependent daycare account, which allows you to run through daycare expenses for your tax dependents who are being watched by someone when they're under 13 years of age and it's during your work hours. The idea behind pre-tax flexible spending accounts is that you are allowed, by using them, to send money to from your paychecks into your account with the company Task. That's who runs our FSA accounts in 2026. And the money you send to that FSA is not part of the 2026 taxable income that you are reporting when you file taxes. So for example, on the screen, you see someone who does not have the FSA and they have earned in their job $200, but before they ever received their paycheck, taxes were withheld for income taxes. And so they may have received just $150 on their paycheck, and they can spend that money, of course, on anything they would like. If, however, they had elected the health FSA and that $200 that they had earned as an employee, they had elected to send that to the flexible spending account, then no income taxes would be withheld from that $200. It would also not come to them on their paycheck. Instead, that $200 would be sent to the flexible spending account, and it would be waiting for them there to be spent on qualifying 2026 expenses. There are risks to electing a pre-tax flexible spending account. The money that you're sending to your FSA has a deadline by which you must have incurred an expense and used the money. If you don't, you can forfeit the unspent money that had been sitting in your account. Usually, the plan year ends December 31st, 2026, if you were electing this for 2026. So even if you're being hired mid-year, this year's plan ends at the end of the calendar year, unless your employment ends earlier, in which case you generally have to incur health expenses no later than the last day of the month in which your employment has ended. And you can only use the money that's in the account, in the FSA, for certain qualified expenses. So when we say you must incur an expense, we mean that you have received the service on a certain date that was allowed for your account. So the examples on the screen share some ideas. Off the top of my head, if you have the account and it's active as of July 1st, then when you go to the doctor on July 2nd or July 15th, then that could be an eligible expense that you are incurring in that time period when your account was active. But you couldn't go back, if your account started July 1st, you couldn't go back and use it for things that had happened to you in June or in May or in January because you didn't have the account at that time. And then when we talk about eligible or qualifying expenses, we're noting that there are only certain ways you're supposed to access your FSA funds. Certain medical, dental, and vision related expenses, certain childcare bills if you're on the dependent daycare account. And so you'll want to learn more about what's considered an eligible expense because you are responsible for learning how to use your FSA. There are resources that Task offers about eligible expenses, but you want to be sure that if you're accessing money from your flexible spending account, that it is, per the IRS, an allowable, eligible, qualifying expense for the type of account that you have. And then while I warned about the possibility of forfeiting unused money, there is a certain way where for the health and the limited purpose FSAs, a certain amount of money from one year to the next that hadn't been used may be carried forward and still follow you in your ongoing employment at the UW. So the situation is this: if you have the health or the limited purpose FSA, at the end of the year, do you have a balance of $50 or more that you hadn't yet been able to use? If the answer is yes, then, and your balance does have $50 or more, or you've re-elected to add more money into the FSA for the next calendar year, then yes, you will have a balance carry over up to the maximum allowed for that year. Right now, the maximums are above $600, but there is a point where if you have more than that that you hadn't used, you would forfeit the extra. Now, on the other hand, if your balance at the end of the year is less than $50 and you do not re-elect to add new money to the account the following calendar year, then you will lose that remaining smaller balance. It will be forfeit. And this slide shows more detail about that limited rollover. Right now, the limit that one could allow to be rolled over from one year to the next is as much as $660. And there is no rollover for the dependent daycare FSA. That is an absolute use it or lose it account. Even if your employment continues from one year to the next, you do forfeit any unspent balance. If you have a health or a limited purpose FSA, then the entire amount of money that you pledge to contribute for the year is available to be used upfront. You'll be issued an FSA debit card, and you could begin to use it at your doctor's office, at the pharmacy, or to pay your eligible bills online. The amount that it will pay will be up to the full amount that you pledged for the year. It will be available to you. On the other hand, if you have the dependent daycare FSA, there is no actual starting balance to that account. So your account opens, there's no money in it though until you have a paycheck and the money is sent to the account, and then you can submit a claim to withdraw the money and reimburse yourself for an eligible childcare expense. There is no debit card associated with a dependent daycare FSA. There are very few allowances for mid-year changes with flexible spending accounts. Usually you cannot change your election. That could be allowed if you have a certain type of qualifying life event and you submit a change form within 30 days of that event. But you'll want to look at TASC's website or ask questions of your HR or our benefit services office if you have questions about making mid-year changes. And a very important part about your flexible spending account is that you will need to substantiate your claims, which means that when you use your debit card or you submit a claim to be run through your flexible spending account so that you can access that pre-tax money, you have to be ready to provide documents to TASC to prove that it was in fact an eligible expense. If you do not or cannot timely substantiate your claim, then your claim will be denied. And if you had already used your debit card to pay for something that then you can't substantiate, you have to repay the FSA directly. And if you don't, then in fact, they'll deduct the money from your paycheck. Um, so pay attention to communications that you get from TASC asking you to substantiate your claims. That is a requirement to use this program. For more information about health flexible spending accounts, and indeed some health savings accounts that we haven't talked about yet, we will later with the health section, look up IRS publication 969. And for more information about dependent daycare accounts, look up IRS publication 503. Your flexible spending account effective date is the first of the month following your date of eligible hire, or if your date of hire was in fact the first, then it will be effective on your very date of hire. The UW also has certain parking and transit pre-tax accounts that we'd like to introduce you to. First, please learn more about the transportation office at the UW-Madison. They allow you to purchase Madison Metro bus passes. They also have information about emergency taxi vouchers. They have what they call the Commuter Solutions resource, where you can find how to bus or bike or walk from home to work and back again. And they also offer pre-tax parking deductions via payroll if you are an employee who purchases an annual base lot permit. That is perhaps the most convenient way to pay pre-tax for parking, assuming you do have an annual base lot permit. There are other parking and transit pre-tax accounts available with TASC. The transit account is for those who have to pay out of pocket for a ride share, or they take a train or a subway to work, a van pool, they take a bus that's not part of this Madison Metro setup. They can elect the transit account, contribute a certain amount per month, and then use that money that's in their account to pay for those transit services that are for the purpose of their job. There's also a parking flexible spending account here with TASC. The parking account is not necessary, perhaps, if you are already arranging to pay pre-tax parking for an annual base lot permit directly to the transportation office. But maybe you're not doing that. You are parking in some other parking garage, or you have a monthly parking pass. In those cases, if you'd like to, you can sign up for the pre-tax parking account, contribute a certain amount per month, and again, use that money to reimburse yourself for your parking expenses. For the pre-tax parking account with TASC, the money is available to spend when you deposit it, not before, and you may enroll or change or stop your participation at any time. For the transit pre-tax account with TASC, again, the money is available to spend only once you've deposited it, and you can enroll, change, or stop your participation in the transit account at any time. The parking and transit accounts also have a $50 minimum carryover, similar to what we had discussed with the health and the limited purpose FSAs. And for the parking and transit accounts, because they are eligible to be enrolled in at any time of year, you should just note that if you were to sign up for one, then it will be effective the first of the month after your application has been received. Here we have information about the accidental death and dismemberment, or AD&D insurance, and the state's accident insurance. And though these programs both have accident in their titles, they are two different plans with two different providers, and you can choose to enroll in both or neither, or just choose one or the other. I'll start first with the Universities of Wisconsin's accidental death and dismemberment policy. We usually just call this AD&D for short. The AD&D policy allows you to elect coverage that would pay out to your beneficiaries in the event of your accidental death, or that might pay you yourself if you were dismembered in an accident and still lived. So the benefit could be as small of an election as $25,000 or increase in increments all the way up to $500,000. And what you would pay per month depends on which of those benefit amounts you've elected, and then whether you want the coverage just for yourself or whether you're going to extend it to your family. If you do elect family coverage, then the benefits for your covered dependents will be a percentage of your own benefit amount. And the types of coverages that are available with the AD&D policy are listed in part here. There is 24/7 accident protection, there's the optional dependent coverage as we introduced, and then there's a certain schedule of the payout, depending upon whether someone passes away or there's a dismemberment and they yet live. So depending upon how bad the accident is, how grievous the injury it results in, there would be certain payouts provided. If you do enroll in the accidental death and dismemberment policy, you must file your own claims with Zurich. So if you do elect this coverage, remember that you have it, put the plan information in your important papers section, and don't hesitate to file claims quickly if you or your covered dependents were injured in an accident. There is also, with this program, free travel assistance and identity theft assistance programs. So you are welcome to use those as well if you're enrolling in the AD&D plan. And this AD&D coverage is effective the first of the month after 30 days of eligible employment. Next, we have our accident insurance with Securian. This plan is part of the state of Wisconsin's offerings, and so you are allowed to cover yourself or your legal spouse or you and your children, or both you, your spouse, and your children. And the price you will pay per month depends on which of those elections you make. With this accident insurance, if you have an accident, you should make a claim, and then the plan will evaluate your claim and may pay you a set amount based on the injury that you or your covered family member incurred. There could be payouts for certain accidental concussions, dislocations, an x-ray that was needed because of an accidental injury, and there's even an accidental death and dismemberment payout if you were to die in an accident. It could be up to $100,000. Here's an example of how this accident insurance may work. Let's say you're enrolled in the coverage, and then once you're actually covered by the plan, you do fall off a ladder. You break your leg and your wrist. You have to be driven to the emergency room in an ambulance, and you end up staying at the hospital for 2 days before they release you to go back home. You then submit your paperwork and your claim to Securian. They review it, and they determine that for various injuries and circumstances, they are able to pay you $3,300 for your situation. That money is paid directly to you, and then you can do with that money what you will. Maybe it helps you pay your medical bills, or maybe those were already taken care of by insurance. And so you can use the money to order in food or to pay, in the example on the screen, for your childcare or for a dog sitter. The money is given to you and you spend it as how is best for you. If you do incur an accident, you have to submit your own claims to Securian. So you'll want to reach out to them quickly following an accident so that you begin the paperwork process. And the accident insurance is effective the first day of the month following your date of eligible hire or on your date of hire if your date of hire was the first itself. Next up, we have life insurance information. Life insurance is a policy that would pay a benefit or an amount of money to your beneficiary, which might be one person, multiple people, or even an entity like a charity of your choice, if you were to die while having coverage under this plan. The idea is that the beneficiaries can then use that money to continue on without you. They can continue to pay for the mortgage or the rent. They can continue to save and prepare for childcare, education expenses. It replaces essentially your lost household income. Or sometimes it just is important for you, perhaps personally, to leave money to a charity that you love. So you may consider electing employee life insurance as a new hire if someone in your life relies upon your earnings to help pay their important bills, or perhaps if someone has co-signed on a loan with you and upon your death, they would become responsible for those payments. You may also want it simply to cover the cost of your funeral. And you want to think about it here as an employee, knowing that you may elect it as a new hire through your employer, and it is a guaranteed issue, meaning that the insurance company can't deny your coverage if you elect it timely. It's not based on your health at the moment, it's based on your new employment and that you chose to elect it. You should complete a beneficiary designation form for any of the life insurance plans that you elect so that the insurance company knows who should receive money if you were to die while having this coverage. And it is your choice who your beneficiaries will be, whether you want to choose one person and leave the entire benefit to them, or multiple beneficiaries and divide according to a percentage system or a dollar amount. You may do that when you file your paperwork with the insurance company. So we have two life insurance options available to our WRS participants. You may elect both of them or neither of them, or just choose one or the other, depending upon what it is that you want. There's the state group life insurance, and its cost, if you were to enroll in it, depends on your age, as well as your income level and how much of the coverage you choose. They have certain amounts that you can elect. The individual and family life insurance, its cost depends on your age and then how much of the coverage you choose. It doesn't depend on your income. If you do want to elect life insurance, be certain that you do submit and we receive your enrollments within your first 30 days. If you do not enroll timely by that deadline, you have waived the coverage by default. If you don't apply for life insurance timely and instead you find yourself applying late, there may not be an actual enrollment for you to be had. So for example, the state group life insurance, if you don't enroll as a new employee, could allow you to enroll in one unit, which equals 1 times your annual salary. If in the future you have a life event like a marriage or the birth of a child, and then you submit your application for that additional unit within 30 days of that life event. Otherwise, if you apply late for the state group life and it's not within an immediate eligible life event, you have to go through what they call evidence of insurability and share medical information with the insurance company and then wait to hear from them whether they approve or deny your application. The evidence of insurability enrollment is not guaranteed. Um, and so that is the case with individual and family life. If you don't enroll as a new employee, then you can attempt to enroll in the future through evidence of insurability. But again, your medical information, their review, you'll have to wait to hear from them whether they approve it or not. The EONI enrollments are not guaranteed. So for the state group life insurance, some plan details. There are as many as 5 units you can elect on your own life through state group life. Each unit is worth 1 times your highest WRS earnings from a year, rounded up. So there's the first unit, which they call the basic unit, worth 1 times your annual salary. There's a second unit, which they call the supplemental unit, worth another times your annual salary. And then there are one, two, or three additional units, again, each of them worth one times your annual salary. So altogether, if you took all that was available, you would have 5 times your annual salary's worth of life insurance. And then if you have a spouse or dependent children, you could elect one or two units for the family members, and they just come at a certain flat dollar amount, depending upon whether you want just the one or both of the units. When you're in the online system and you're considering enrolling in state group life units, it will populate the prices that should be affecting you if you were to actually submit enrollment. But if you want to run numbers longhand, we have information here on the slide for you. And then their individual and family life insurance, or INF plan, offers coverage to new employees. As an employee, you can elect as little as $5,000 or moving up in $5,000 increments up to $20,000 as a new hire with a guaranteed issue. If you have a spouse or a domestic partner, you can elect $5,000 or $10,000 on their life. And if you have eligible children, you can elect $2,500 or $5,000 on their life. You'll see an example of the price per month on the right-hand side of the screen if you were to enroll for yourself for the $20,000 election, the highest you can go. Again, it depends on your age as to what you would pay per month. There are also maximum coverage levels that are allowed through this program. And let me flip to the next slide here. So for the INF policy, if you enroll as a new employee, you can begin to increase the level of your coverage that you're enrolled in and are paying for during the fall open enrollment every year. So these step ups can be, year by year, you can increase, for example, another $20,000 until eventually, after many years, you have as much as $300,000 on your own life, as much as $150,000 on your spouse or partner, and as much as $25,000 on your child. These annual increases for individual and family coverage are not offered to you if you didn't already enroll as a new hire. And for these life insurance plans, if you're enrolling in one or the other or both, they are effective the first day of the month following the entry date of your timely application. This section is about disability insurance, also called income continuation, or ICI for short. The ICI policy can pay you up to 75% of your average monthly earnings if you need to stop working because you are disabled and you meet certain plan requirements. So if you become injured or ill and cannot do your job here at the UW, you must meet certain plan requirements, but then they could begin to send to you up to 75% of your average monthly income so that you continue to have income coming into your household. There are two types to the disability insurance. Most often, people have a short-term disability situation, if they have one at all, which means that at least for a year, they've been disabled, they're unable to perform the duties of their job. But if it turns into a longer-term disability situation, it's been a year and now longer, this program may still continue to pay them out, assuming they are unable to work in any substantially gainful activity. The ICI disability program can begin to pay you once you have served an elimination period, which means you've been disabled for a certain length of time, and assuming you've used all your sick leave hours, or at least all that they require you to use. So if you are a university staff employee, your elimination period is 30 days. You have to be disabled for at least 30 days before you can begin to participate in this program. And if you have sick leave hours, you have to use all of your sick leave or up to at least 130 days. If you have a lot of sick leave, you have to use at least 130 days before the program can begin to send you money. Now, if instead you're faculty or academic staff, when you're enrolling in this ICI plan, you choose an elimination period, whether it's 30 days, 90 days, 125 days, or 180 days. And then that's the elimination period that you have to meet before the program could kick in, as well as, of course, that requirement that you have also used up all of your sick leave. Or, again, if you have a lot of sick leave saved, you have to use at least 130 days before the program can kick in. And then if you have become qualified for the ICI disability plans and they pay you up to 75% of your income, the benefits would end when you can again perform the duties of your position, or if it's a long-term disability, any position, or when you return to your former employer status, or when you pass away. There's a price to pay, of course, to enroll in the ICI disability insurance plan. More details are on our website. There's a premium calculator, for example, that you might find useful. But also, when you're enrolling in the My Insurance Benefits portal, depending upon the elections that you're making, you'll see a quote of what the monthly premium will be for you. Now, the effective date, the start date for your ICI disability insurance, depends on whether you are university staff or whether you are faculty, academic staff, or limited appointee. FASTLY is the short term for that group of employees. If you are university staff enrolling as a new hire into the ICI, then your coverage is effective the first day of the month following your date of hire, or on your date of hire if your start date was the first itself. Things may be different if you're faculty and academic staff. So in this FASTLY category, there is an early ICI benefit where you can begin first of the month following your date of hire, and then for the first up to a year of employment until you've met 12 months of WRS state service, you are enrolled in the plan, but you're paying the full premium yourself. The other hand, if you want to enroll as FASTLY into the ICI, you might choose to have your coverage effective the first of the month only after you've earned 12 months of WRS state service. And when that happens, when you've had 12 months of state service, then the UW is going to pay a share of the monthly premium cost for you. Now, if you want that program rather than the early enrollment, you have to initially decline coverage as a new hire, but then remember to enroll later as you're approaching earning 12 months of WRS state service. So if you are faculty or academic staff, you will see the option for income continuation to either elect or decline the coverage. And if you want to decline it initially because you don't want to pay the full premium for those first 12 months of state service, you could decline and then remember to apply at a future date due to having meeting the 12 months of state service and then being eligible for the employer contribution. Many people ask about the disability insurance and if they have a child. So yes, potentially, ICI can provide a covered birthing employee as many as 6 weeks of disability from the date of delivery. That might be 8 weeks if you had a cesarean. But as with any disability claim, before the ICI benefit can be paid out to you, you have to both serve your elimination period and exhaust your sick leave. So because of that requirement, your ICI benefit might not pay you following a birth if your sick leave balance was large enough to keep you in full pay status for the course of your disability for that 6 weeks or 8 weeks, or if your elimination period was a longer one, 90 days, 125 days, etc., but you were only disabled per your doctor for a shorter time, the 6 weeks or the 8 weeks mark. So I would encourage you to learn more about parental leave at the UW-Madison. This is a program that became effective July of 2024, and this policy allows certain employees who meet requirements to receive continuing pay while they're out on parental leave following the birth or adoption of a child. If you have questions about paid parental leave, please reach out to your local HR and talk to them. A review here of the ICI disability enrollment opportunities. Right now, assuming you are a new hire, you have your initial first 30 days to sign up for the ICI enrollment and be part of the plan. Or perhaps you'll be invited to join in the future during a deferred enrollment. For example, if university staff have been working and saving enough sick leave that is moving from one year to the next, they may receive an email letting them know that they have a deferred enrollment opportunity, a new opportunity to sign up for the ICI disability plan without any medical questions being asked. I can't guarantee that that will be true for you in your case, but if you initially decline, keep an eye out for a deferred enrollment invitation and take action at that time if you want to. The other way to apply, once you're no longer a new employee and you're not being offered deferred enrollment, is to apply through the evidence of insurability process, which again requires you to complete information about your medical situations. You send it to the insurance company, and then they decide whether they want to grant you late enrollment. There is no guarantee that they will say yes. You may be denied. We're moving on here to health insurance, but we're starting off with the opt-out incentive for state health insurance. So if rather than enrolling in health insurance as our employee, you decide to elect the opt-out incentive and thus not be enrolled in health insurance, by electing the opt-out incentive, you can receive $166 per month. This is extra taxable income added to your paychecks that is not WRS income. So it doesn't have the percentage withheld from the top. It doesn't affect your retirement annuity at all. There are requirements about who is allowed to be part of the opt-out incentive. So you can look at ETF's website for more information on that. And a very important note that if you do enroll in the opt-out incentive and you want it again for next year, you have to take action during the fall open enrollment period to re-elect the opt-out incentive so that you continue to receive it for the following year. So it requires at least an annual action on your part to continue it. So one example of some eligibility criteria for the opt-out incentive is that you cannot be covered by state group health insurance and receive the opt-out incentive. And that's true even if the coverage that you're on is not in your own name, but instead it's because you're a dependent on someone else's policy. So the example on the screen here shows on the left, if your spouse or parent is a state of Wisconsin employee, and you are covered by their health insurance, then you will not be eligible for the opt-out incentive because you do have the state's health insurance. It's just under your spouse or your parent. Well, on the other hand, if you are not covered by their state group health insurance, then you could be eligible for the opt-out incentive. Similarly, on the right-hand side there, if your spouse or parent is not a state of Wisconsin employee, you're on their health insurance, then you could be eligible for the opt-out incentive. So take a look at ETF's website, and if you're going to decide not to enroll in the health anyway, choose the opt-out incentive and you'll be evaluated. Here is the health insurance information if you are planning to enroll in health, details about what it costs and how the plans work. First off, I'll admit that my review today in our presentation is a quick one. So for more information about the plan designs and what they cover, I would encourage you to take a look at the resources available on Employee Trust Fund's website. They have a fantastic video about choosing a plan design, and they have a great step-by-step kind of consideration of the different needs that you or your family may have as you consider your options. I'm starting out with effective dates for state group health. And I'm starting with faculty, academic staff, and limited appointees. If you are a Fastly employee and you're enrolling in state group health, then your coverage will be effective the first day of the month following your date of hire. Or if your date of hire was the first, your coverage is retroeffective back to the first, assuming that you submit your enrollments timely. If you are university staff, you may have different options of when your health insurance may begin. And I'll walk through them here for you. We have a pretend employee, Jane, who is a new university staff employee. They were hired in June and they have no previous WRS or state service. So Jane's first option is to have state group health insurance effective July 1st, the first of the month following her date of hire. If she chooses that option, she is going to pay the full monthly premium cost for health insurance for the first 2 months of her coverage. For all of July and all of August, she's paying the full monthly premium. And I'll have information about those full premiums on the next slide. And then beginning with September, the UW will begin to pay most of the monthly premium for her, and she will pay a much smaller share out of her paychecks. Now, her other option is to have her health insurance begin September 1st itself, the first of the month after she's completed 2 months of state service. Now, that would mean that she has no health insurance for July and August with us, and instead her coverage would only begin on September 1st. And right from the start for her then, the UW would pay most of the premium, and she would begin to just pay her much smaller share. So let's take a look at the full premium costs on the next slide. These are examples of the health plan and the nationwide access plan full monthly costs for 2026. Um, of course, the full costs depend on which plan you're electing, and then whether you want individual or family coverage with or without that preventive dental, the uniform dental as part of the program. So the access plan is a nationwide plan. The Dean, the GHC Dane Choice, and the Quartz UW Health options there are all programs that offer Dane County area doctors. And there are fuller lists of providers elsewhere in Wisconsin available on Employee Trust Fund's website. If you are a university staff employee and you're going into your My Insurance Benefits portal and you do not have the full 2 months already of state Wisconsin Retirement System service, you might see something like this. It's asking you about the employer contribution wait period and how you want to deal with that. Do you want to enroll in the coverage right away and you'll pay the full premium for those months until the UW begins to contribute their share? Or do you want to delay your coverage? So you're enrolling, but you don't want it to start right away. You want to start only after the employer contribution comes into play. That will be something that you will choose when you're in your My Insurance Benefits portal. This slide shows the monthly premiums for health insurance once you are eligible for the regular employer contribution towards your health premiums. What you will pay per month depends on whether you want individual or family coverage. And then again, whether you're choosing the coverage just including the preventive dental, uniform dental policy, or if you're choosing it without the uniform dental. So there are 4 different plan designs. There's kind of the basic health plan, and then there's its high deductible version. There's also the nationwide access plan and its high deductible version. And we'll talk about each of those today. Now note down below that while these are the typical monthly premiums for active employees, you might pay more if you are a new university staff employee and you choose to start your health coverage before you have the full 2 months of state service, or if you work 49% or less. So if you're less than half time, or you hold a single university staff temporary appointment, you would pay a different amount. And in that last bullet point case, you would pay 50% of the monthly premium, and the UW would pay the other 50% each month. It will be important when you're enrolling in health insurance to make sure you choose a network that is convenient for you, that has the doctors that are near to you, the doctors that you want to visit. And so one way to find your networks is to visit Employee Trust Fund's website, go to their health plan search. You can look up the different counties that are available here in Wisconsin, review each plan step by step, look at the different network options, and choose the one that's best for you. So when you're choosing your network of providers, you're either choosing one of kind of the Wisconsin-based plans, or Dean, Quartz UW as the examples there, or you're going to choose the access plan with its nationwide coverage. And then you're also choosing whether you want the low deductible kind of traditional style insurance, or if you want the high deductible health plan style with the health savings account. Here again is where that video, choosing a plan design, can be so useful. It will review these different designs and what you might want to think about as you're making your decisions. If you choose one of the Wisconsin-based designs, again, you're choosing either the low deductible copay plan or you're choosing the high deductible health plan version. If you're choosing one of those, make sure that you only ever visit your in-network providers unless it's an emergency or an urgent situation. Because if you visit an out-of-network provider and it's not urgent or an emergency situation, you will not have coverage. It's a little more lenient if you choose the nationwide plan, the access plan or its high deductible version. They encourage you to visit providers within their network, but they allow you to go outside of the network. They just offer less coverage if that's what you choose. Just to note once more that if you're enrolling in health insurance and you also want preventive dental, you're going to be enrolling in the uniform dental plan when you're in the My Insurance Benefit portal. And you can learn more about the preventive uniform dental going out to Delta Dental's website and asking questions of their member services team if you'd like. So back to actual health enrollment itself. If you were to choose one of the Wisconsin-based plans, you'll see what you would pay per month, depending upon your election. If you were choosing an individual policy and you want the uniform dental and you're choosing the low deductible copay plan, you would pay $132 a month. Or if you also have family that you're going to cover on that same policy, it would be $329 a month. You'll see that the high deductible versions are less expensive to be part of. Lower premiums are being withheld from your paychecks. But what's important for these types of Wisconsin-based plans is that you're choosing a network of doctors that you agree to be your doctors for the rest of the year, and you will only visit those chosen providers unless there's an emergency urgent situation. Now, in Dane County, here where Madison is located, the Dane County networks include Dean Health and Group Health Cooperative of South Central Wisconsin's Dane Choice, and the Quartz UW Health Network. Those are all Dane County options. It's very possible that you don't need a Dane County option though, and so I encourage you again to take a look at Employee Trust Fund's Health Plan Search webpage so that you are identifying the networks that are available for you and your family in the area where you would actually want to visit them. And a note, if you need coverage outside of Wisconsin. If you plan to seek medical care immediately outside of Wisconsin, in an immediately surrounding state, there may still be a Wisconsin-based health plan option that will offer you in-network options. Some of those Wisconsin-based plans stretch over the border into the surrounding states. So again, take a look at Employee Trust Fund's website and look for those Wisconsin plans that do have coverage in other states, if that is something that would be useful for you and your family. And sometimes we need a large network from which to choose. We need a nationwide option, whether that's because we travel a lot or because we have more than one residence in different parts of the states, or we have different family members living in different areas, or you might just live in Texas or in Washington State or in Washington, D.C. And in those cases, the Wisconsin-based plans may not be of use to you. So these access plans may be instead what you decide to elect. Um, Again, the monthly premiums are noted for the access plan with its low deductible versus the high deductible version. And if you elect one of the access plans, then you may visit in-network providers with Dean and with First Health. But if you go outside of their networks, you do still have some coverage, even if it's not for an emergency. They just pay less towards those charges. And I'll have more on that coming up. So as you are making your decisions about which program you want to elect for health insurance, consider visiting the websites, giving them a call, talking to the member services lines, finding out if you have a current doctor that you prefer, whether any of these networks include them. Think about where you live and where you work and where is it important for you to have clinics nearby? Is it more important to have them near your home or is it more important to have them near where you are working? You can also ask about telemedicine services and about the hospitals that they would use if you needed surgeries. Any of that might help you narrow down your choices. Now, if you do enroll in one of the health plans, the coverage has become effective, and you are now visiting your network provider and receiving preventive care, your preventive care is covered 100% per federal law. So that means at no cost to you, you would have your routine annual checkups, certain screenings for illnesses based on sex and age, certain well baby checkups, certain women's checkups, and certain prescriptions when you fill them at your network pharmacies, things like contraceptives, would be provided to you because of law at no cost to you. It's when your care is not preventive that you have to pay something for the care that you're receiving. So you will owe money of some sort for your covered visits and services and prescriptions, but there is an annual maximum to how much you must pay for those covered visits and services and prescriptions. And next up, we'll talk about how much you pay and when you might pay it, depending upon which of the deductible types of plans you elect. So we'll start talking about the health plan and the access plan. One, of course, is Wisconsin-based. The other one is a nationwide network, but both are traditional, low-deductible copay plans. If you choose one of the Wisconsin-based health plans or the nationwide access plan, and you go in for your preventive care at an office visit, so you're seeing your general physician or you're taking your child to their pediatrician, you're visiting a nurse practitioner or your OB, then that preventive care is covered 100%. You pay nothing as an office visit charge. But it's when you're seeking care that is not preventive, that then you will have a cost to you to pay for those office visits. If you're visiting your primary care providers, including your mental health counselors, your chiropractor, you will pay $15 for the office visit copay. If you're visiting a specialist or going into an urgent care clinic or having a vision eye exam with your in-network ophthalmologist, then you pay a $25 office visit copay. And if you need to go to the emergency room, then you will pay a $75 copay, assuming you're not admitted to the hospital. So what this might look like is if I have a headache and I go to my general physician to talk about my headaches, and she counsels me and gives me ideas on how to relieve the pain, then I would leave that office visit having likely paid at the front desk $15 as my copay. She might charge $200 for the consultation, but I took care of my share when I paid my $15. Sometimes you need more than just an office visit. You need x-rays or diagnostic labs or surgical procedures. And in those cases, you must pay your annual deductible, your medical annual deductible off the top of that bill for the first time. That happens every year. So if in my previous example, I was talking to my doctor about my headaches, and I paid my $15 to talk to her. But then she says, I'm worried about your head. Let's go down and get you a CT scan, or let's draw some blood to see about your allergies. Then that's no longer just an office consult. Now we're trotting on down to the x-ray area. Radiologists might need to view things, or I need to go to the lab and they might draw blood to be reviewed in the lab. That goes towards my medical annual deductible for the year. And the deductible is $250 per person per year. If you have a family plan, though, and multiple people in your family are all having x-rays or labs or surgeries, at most the family maximum is $500. So for those items that went towards your deductible, the remaining cost of them would be handled through coinsurance. So you pay your first $250 off the top of the bill, and then the rest of the bill for medical care would be covered 90% by the insurance company, and you pay 10%. Or if they're issuing you durable medical equipment, then you pay 20% of that cost, and the insurance company is paying 80% of the cost. If one person in your plan meets a $1,250 medical out-of-pocket limit, for the rest of that year, that person pays nothing more for their office visits, for their covered medical care, for the durable medical equipment, for those things that are covered and received in network. They are free to you, and the insurance pays 100%. So if I were to, again, go and have that CT scan, I paid my $15 to talk to my doctor. I then paid $250 towards the cost of the CT, and then I paid 10% of the rest of the bill. If after all of that and more, possibly, I've spent as much as $1,250, then I stop paying. And for the rest of my care for that year, the insurance company pays 100%. Or if this were family coverage and multiple people were having all of these multiple services, then at most $2,500 is what the family would pay for those covered medical items. That's known as the out-of-pocket limit. Also with the health plan and the access plan comes certain pharmacy benefits. You can search the Navitus formulary. Navitus is the company who runs the pharmacy benefits. And you'll find different prescriptions are put into different levels, and that's how you know how much you will pay for them. Some prescriptions will be considered preventive, and you'll pay nothing for them when you fill them at your in-network pharmacy. Other prescriptions may have a level 1 or a level 2 next to them. You would pay up to $5 per fill for level 1s. You'd pay 20% of the cost of a level 2, but never more than $50 at most. Or you might decide to go through the Costco mail order pharmacy if you have regular level 1 and level 2s that you fill and get 90 days of those drugs mailed to you for the cost of just 60 days. So 3 fills for the cost of 2. There might also be level 3 drugs that you need filled, and depending upon whether you have a letter of medical necessity from your doctor, there would be different costs for those level 3s. Um, and then level 4 drugs might be specialty drugs that you fill at the UW specialty pharmacy or through Lumicera, and you pay $50 per fill for those. There are out-of-pocket limits for your pharmacy benefits as well. So under the health plan and the access plan, um, depending upon which prescription levels you've been filling, you wouldn't pay more than $600 per person for levels 1 and 2 over the course of a year, and not more than $10,600 per person for levels 3 and 4. You'll need to visit in-network pharmacies to use your Navitus state prescription coverage, and you'll be able to search for those out on the benefitplans.navitus.com website. Here's a quick overview of what the in-network coverage looks like under these traditional low deductible plans. Towards the top there, you see that there are prescription drugs that have certain copays or coinsurance amounts. And if you fill so many that you reach the out-of-pocket limit for a prescription tier, then the insurance company pays 100% of additional prescriptions in that tier through the rest of the calendar year. On the lower portion of the slide, you see that there are office visit copays. There's the medical deductible that you need to meet for certain items like labs, hospital services, durable medical equipment. And if you need to meet the deductible, then there's coinsurance after that. And if you ultimately, between all of that, meet the medical out-of-pocket limit of $1,250, then for the rest of the calendar year, the insurance pays 100% of that person's covered care services. Now, our year resets every January 1st. So if you are beginning the health insurance mid to late 2026, you'll have just through December 31st on this particular plan, and then things reset and restart January 1st. In this next section, we're talking about the high deductible health plan versions of these same programs. We still have a Wisconsin-based plan, we have the Access nationwide plan, but these are with their high deductible health plan versions. There are rules about which employees are eligible for the high deductible health plans because of eligibility for the health savings accounts that come along with them. So note that you must be a Wisconsin retirement system participant to enroll in a high deductible health plan. You also cannot be claimed as a dependent on someone else's taxes for the year, and you cannot be covered by some other non-high deductible health plan or health FSA elsewhere. You also have to apply for and be approved for the health savings account through TASC for the year. Some basics about high deductible health plans are that they charge less for the monthly premium. So you have less money coming out every pay period to be part of the insurance plan compared to the other lower deductible plans. But there is a higher annual deductible to meet before the insurance kicks in and begins to pay more of the bills that you incur. A key part of these high deductible health plans is that they are paired with a health savings account. And this is a bank account that you would open, and then into that HSA, the UW will contribute money, either $71 a month if you have single coverage or $142 a month if you have family coverage. The idea is that the money that is being put into the health savings account can then be used by you to pay for services that are going towards your high deductible. So under these high deductible health plans, at first, you pay 100% of the full negotiated cost for your non-preventive care. Remember that your preventive care is covered 100% because of the Affordable Care Act. So this is for things that are not considered as preventive. They're not being billed as preventive. They're diagnostic, they're prescription drugs, they're the office visits when you have a headache, they're surgical procedures, diagnostic labs. You are responsible for the first $1,700 if it's just you on the policy, or you're responsible for the first $3,400 if you elected family coverage. If you have elected the high deductible health plan and you do have so many services that you meet your plan's annual deductible. Again, $1,700 if it's just you on the plan, or it's $3,400 if you have the family coverage. Even if it's just one of you seeking service, the deductible is $3,400. If you meet that, then for the rest of the calendar year, the insurance pays a share of your bills and you pay a much smaller share. You pay just the office visit copays or the prescription drug copays or coinsurance. And you have then these smaller shares of additional bills until you reach the out-of-pocket limit for the year. The out-of-pocket limit for the high deductible health plans in-network care is $2,500 if it's a single plan, or $5,000 if it was a family plan. And remember, for those family plans, the out-of-pocket limit is applied to any of the bills that family has sent. So it is possible that one person in the family could incur that entire $5,000 all by themselves if they were the one who needed all the medical care. Now, bringing back that idea about the health savings account, the UW contributes into your health savings account if you're enrolled in one of the high deductible health plans. And you might contribute your own money if you want to, but that's optional. There's a certain amount that the federal government allows you to contribute total into an HSA every year. So the UW will send some money into it. You can decide to send your own money into it up to the total federal allowed amounts. And then as you decide to spend money from the HSA, you must keep documentation of the reasons you're taking the money out. Make sure that you have proof of eligible expenses so that if you are audited and the IRS wants to know how you were using the money from your HSA, you have proof that they were for eligible expenses. The idea is that you are avoiding taxes on the money that was both contributed into the HSA and that you are now using out of the HSA to pay for eligible expenses. One of the HSA eligibility requirements is that you must pass an identity verification process. So TASC, who is managing these HSA accounts for the state, may email you and request documentation that you need to follow up with them about. They may need more information about your legal name, your address, your date of birth, more information about your government ID information. And this will be between you and TASC. We at the UW aren't able to help with this process. And it's because you are opening the bank account called the HSA. And so TASC needs to verify certain things about you because of the US Patriot Act. There's also a couple of slides here about health savings accounts and how they compare to flexible spending accounts. You may find this interesting if you're thinking of one or the other type of health election and then account enrollment. I would say the basics are that the health savings accounts are actual bank accounts that you open yourself, and that then the money that's in it belongs to you and you choose how to spend it. The health flexible spending accounts or the limited purpose flexible spending accounts are employer accounts that you elect to participate in, and you elect how much money you want to send to the account. There is no employer contribution. And these are use it or lose it accounts. It's not a real bank account. It's a program that you're supposed to use every year and that it kind of resets year by year if you're re-electing it. Again, take a look at the slides and let us know if you have questions. An overview then of how the in-network coverage works if you're on one of the high deductible health plans. All of your initial non-preventive services, so prescriptions that are not preventive, office visits that weren't part of your annual, free physical, medical care and durable medical equipment, you are paying their full negotiated cost that had been negotiated between the doctor's office or the pharmacy and the insurance groups. You pay the cost until you meet the full deductible for the year, $1,700 if it's a single plan, $3,400 if it was a family plan. And if you do have so many expenses that you do meet the deductible for the year, then the remaining services, if you keep incurring them, are run through copays and coinsurance. And then if you have so many of those that you meet the plan's out-of-pocket limit for the year, then for the rest of the calendar year, the insurance is paying 100%, and things won't reset until January 1st. So again, you have that pre-tax HSA if you're part of one of these plans. The UW puts money into. You might also be putting money into it optionally, and you can withdraw money from your HSA if you want to use it to pay for these eligible expenses. A UW-Madison School of Business professor has evaluated whether, for most of us, a regular health plan versus the high deductible health plan with a health savings account might be better. Um, In general, most everyone, including families with high medical needs, would find savings if they were to enroll with a high deductible health plan. But there is more to talk about, and so you can scan the QR code here and use their cost calculator to perhaps learn what health plan might be better for you. And this slide just shows some considerations that, again, high deductible health plans can be a fantastic way to save, but they're not for everyone. And so, again, take a look at the QR code, talk to the professor's team if you have questions about how they came about their determinations. Then we're going to have a special word here about what if you receive services outside of your elective network for the year. Remember that if you chose the Wisconsin-based health plan, you're meant to visit only in-network providers. You will not have coverage outside of your chosen network unless it was for emergency care or urgent care. Examples of emergency care would be situations where your life is in danger if you don't receive care in the next hour. Severe allergic reactions, severe asthma attacks, heart attacks and strokes, you need to seek emergency care, and that is allowed to be outside of your typical network. What is not usually considered an emergency are fevers without rashes, most dental pain, sore throats, common cold or flu symptoms, most headaches. Those are generally not considered an emergency. And then situations where you might seek care of an urgent care clinic outside of your network might be a broken bone or some minor cuts or sprains, minor burns. Now, if you are nearby to your in-network urgent care, you must go to that in-network urgent care. But if you are traveling and away from your in-network urgent care and you have a sprain or you have a drug reaction, then it is acceptable to go to that out-of-network urgent care clinic since you're too far away from your in-network and you need urgent care. Things that are a bit different if you have the access plan, because again, you're allowed to go outside of their chosen network if you want to, but your costs will be higher. You'll pay the first $500 per person of covered medical services that were received outside of the network. And then you pay 30% of the additional costs. The insurance company pays 70%, and your share might be as much as $2,000 per person per year. Taking a look at the high deductible health plan, Wisconsin version, again, you're meant to visit only your in-network providers. If you go outside of your network, you do not have coverage unless it was for emergency or urgent care. And with the Access high deductible health plan, you are allowed to go outside of your network if you'd like to. It doesn't have to be for an emergency, but you will pay even higher deductibles and out-of-pocket costs if you go outside of the network. Your single deductible would be $2,000 for out-of-network care, or $4,000 if it's a family plan, and then you pay 30% of the additional costs, up to $3,800 if that was a single plan, or $7,600 if it had been a family plan. Please learn more about what the state's health insurance covers, as well as what it excludes, what is not covered in the certificate of coverage available out on Employee Trust Fund's website. And for answers to your additional questions, the details of the plans, how to contact the different networks, visit Employee Trust Fund's website, They have, again, that search function. They have a place where you can find out how to contact the various health plans, and they have a lovely FAQ section. If you have questions about something, it's likely that somebody else has asked those questions as well, and ETF has answers on their website. And then if you are enrolling in health insurance, you will receive ID cards. You'll receive a card from your insurance network, as well as a second card from Navitus for the pharmacy coverage. And then if you'd also elected the preventive uniform dental, you'll receive a card from Delta Dental for that. ID cards may take about 4 weeks after the enrollment is processed to reach you at your home address. It's the insurance company who mails them directly to you. And just make sure that your workday, home, and mailing addresses are correct so that they know where to send your cards once they're ready to issue them. And that wraps us up. Next, we're ending with some key takeaways and the next steps. So you will want to review your copy of this PowerPoint presentation. Again, if you don't find a download of it on our website, you can send an email to us, thebenefits@ohr.wisc.edu, and just ask for a copy of the PowerPoint. And then make sure that you have set up your My Wisconsin ID, and then go into your My Insurance Benefits portal and make your decisions for your benefits on or before your 30th day from your start date under the Wisconsin retirement system. And then in the meantime, reach out to your local HR or reach out to us at the Benefit Services Office if you have questions. An important point I just want to note once again is that in the future, if you have a life event like a marriage or the birth of a child or the divorce or the death of a family member, even if you move from one area of the state to another, you may have options to make changes to your initially elected insurance plans. But each different life event can allow different types of changes, and each of the insurance plans has their own allowances for changes based on life events. So take a look at our website for more information, more detail, and speak up to your local HR and or to our office, the Benefit Services Office, if you are anticipating or have recently had a life event. You usually have only 30 days from the event itself to make a change if you want to. 31 days can be too late. So make sure to take action sooner than later if you have questions about making changes to your benefits because of life changes. And that is it for today's presentation. Thank you for hanging in there with us, and for additional questions, reach out to your local HR and to us, benefits@ohr.wisc.edu. We're happy to help you, and our website is available with many resources. We look forward to working with you and answering your questions, and hope you find this new hire enrollment onboarding process. We hope it's as smooth as it can be. Take care and have a great day.